Let's welcome on board our experts and get a better sense from them directly as to what's going on with cement as a sector. Sanjay Ladiwala and Sanjay Kumar Gupta, CEO at Star Ferro and Cement, joins us on the show right now. Mr. Ladiwala, let me begin the discussion with you. Good morning, firstly. At the start of the year this time around, we expected cement companies in North India as well to do very well from the increased clinker capacity utilization. At the end of 2 months, the North Indian players are outperforming and really seeing that increased kind of traction.
Well, yes. Actually, if you see, demand has picked up slightly in the second half of this year, though I must say the volumes aren't very encouraging. Year on year, they are moving ahead, but very minimally. At the end of this fiscal, we might see about a 2% year-on-year growth, which is neither here nor there. So the only encouraging thing is that the way the volumes had come off in the first half of the year, that has been sort of recouped, and after that we are seeing this year-on-year growth. So I doubt that we will do very well volume-wise. Prices, of course, are very remunerative. They have gone up, and infrastructure demand is the one that's really pushing it. So that is the scenario as on for FY20. Not very encouraging, but not too bad either.
Mr. Ladiwala, for the years and years I've interacted with you, I've always heard two things which have been constant with all your answers. Cement demand long term is great, but in the short term there is more supply than demand. Trust me, I mean, every time we discuss, we always hear the supplies are coming and cyclicality keeps on hitting us.
Well, you're very right, Mr. Dalmia. You're absolutely right. The situation keeps on repeating because every year there is some additional capacity coming on. And till the time that the additional capacity stops, we are never going to see this position of absolute equilibrium. And as long as the demand rate growth is higher than the newer capacity addition rate of growth, we are going to see that history repeats itself and keeps on repeating. And you are very right. I have been consistent with what I've been saying. And in spite of that, we are seeing that the prices are remunerative. But this is, you're right, it happens, it is happening every year. Though last year, and I believe the forthcoming year also, the increase in capacity is not going to be so much. Main growth is now coming from addition of grinding units and debottlenecking rather than greenfield. So maybe, and I'm saying just maybe, a few years down the line, I might be singing a different tune.
Pricing trends. I'll come back to you, Mr. Ladiwala, in just a moment, because we also have Mr. Gupta online. So let me also get him into the conversation. Mr. Gupta, volumes, particularly in the Northeast in the last few years, they've exceeded what we've seen in the overall country from a particular push on housing. Do you see that trend continuing? Where, according to you, is the demand push coming from?
So, as far as we are concerned, we have seen good demand in quarter 4. Even quarter 3 better as compared to quarter 1 and 2 in the current financial year. In the quarter 4, we have seen a healthy volume growth of around 15% in the entire Northeast. And even eastern region, as so to say, Bengal, Bihar, Jharkhand, Odisha, these regions are also seeing at least 6 to 7% of demand growth.
Gupta, you also indicated that the cement unit in Siliguri is expected to get commissioned this year by March, April. Is that on track? What's the kind of numbers that you're expecting from that?
Yeah, so our cement grinding unit of 2 million ton in Siliguri is on track. We are going to start that unit by end of March or early February, early April. And that will take our capacity to 6.5 million ton. In terms of volume, it is not going to add anything in FY 2021. We are expecting at least a 70% capacity utilization in FY 21.
Mr. Ladiwala, let's section this region-wise as well. Where do you see the price hikes kicking in, particularly post-Holi? It's been a subdued environment, of course. We've been talking about that. Can we see that push just towards the end of the year, end of the fiscal year?
Well, region-wise, I think South is still, lagging behind because of not much infrastructure coming up there. North and Northeast, or the East also, are going pretty good. West is sort of neither here nor there. But having said that, we're a little optimistic this year, barring the fact that the monsoons, the delayed monsoons last year, do not affect the agricultural income and therefore the individual housing segment in the rural areas. Assuming that, I think infrastructure should be doing pretty well in FY21. And if that happens, of course, real estate is a goner. I don't think we can see much hope there at all. But if that does well, I think we should see volumes and therefore price support there. And also, the input costs aren't going anywhere. So, margin should be doing relatively much better in FY21, I think.
Mr. Ladiwala, I'll throw two stock market examples at you. In last 10 years, Shree Cement is a 45x. India Cement has given a negative return. So here's one company where you put in 100 rupees, you multiply it by 45, that's 4,500. That's where your capital stands. In India Cement, if you put in 100 rupees, it's come down to 80 rupees. And I know I've got Mr. Gupta there. So Mr. Gupta, this is not pointed towards Star Ferro Cement. It's a general question I'm asking to Mr. Ladiwala, that for an investor who wants to invest in cement, a sector has given two differentiated returns. So how does one figure out investing in the right cement company and right cement stock? And if you have to invest in one cement company, your personal money for next 10 years, where will you invest?
Well, okay. I am not an expert as far as share valuations and market is concerned. However, I'll give you some basics that I would look at. If I have to look at a cement company, I would look at the logistical cost per ton of that cement company, which means the proximity to its home market. That is something that is not going to change ever. So as long as it has got cost savings built in by virtue of its location, which also includes the region where it's in, and we have seen East, Northeast and the North growing consistently. So a company which is situated in these regions and which is very close to the home market would be an ideal choice, because no matter what the market does, their costs are not going to escalate. So I would look at those two factors while, even zeroing on any cement company.
Mr. Gupta, also, in terms of other pricing trends, raw material costs, are you seeing or expecting to see higher realizations going forward?
Definitely coming as far as the quarter 4 and FY21 quarter 1, we are expecting price at least to be on a little firmer side of it, largely because of the demand traction with the entire eastern region has been seeing. I agree that every cement company will have a different take on it, because largely you have given example of India Cement giving a negative return. That is a company which is largely demographically it is based on South, which was having a lot of cement overcapacity. If you look at the companies which are largely based on East, I think, and in the North and West, like Shree Cement has given a very good returns. So overall, I think the pricing on each region will depend on how the demand supply in that particular region is stepping up. I think for FY21, the entire eastern region looks pretty well set in, because the three large states in eastern India are going for elections in next year: Bihar, West Bengal and Assam. that will definitely drive at least the government projects which are unfinished. And we hope that the government will definitely complete those projects. There is a rural demand which is also there and from affordable housing segment, which we are seeing in entire Eastern India. So we are pretty hopeful of FY21 doing pretty well for cement sector.
And thank you for joining us.